Have you ever really stopped to look at college tuition today and then compare it to maybe 20, 25 years ago? It's often 5 times higher. I mean, five
Yeah.
times. That's not just a gradual rise. It's an explosion. Makes planning for education a truly massive financial challenge for so many families. Yeah, it's a pretty stark reality really for anyone navigating it now or, thinking about it for the future. So how do you even begin to ease the burden of these eye-watering costs? Well, that's exactly what we're diving into today. Our mission here is to unpack how the U.S. government offers a bit of a lifeline through these tax efficient savings options. We're going to focus specifically on Section 529 plans. We'll explore the surprising tax benefits, understand the different forms they take, and really try to grasp how they work, including those tricky bits around distributions and penalties that will often catch people out. Okay, but before we dive deeper, just a quick reminder this deep dive is based on material from Farhat lectures. All the content, examples, explanations we talk about here, it's all derived from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe a CPA candidate, or already a professional, definitely visit the website. You'll find additional practice questions, video lectures, loads of detailed support to really reinforce today's topic. And special thanks, of course, to Professor Farhat for providing this valuable material for us to discuss. Okay, so as we just touched upon, the core problem is pretty clear. Education costs are surging, way, way ahead of general inflation. This isn't just a small thing, it's a fundamental shift, a critical financial hurdle for families all across the country.
Exactly. And because this rise is so, well, persistent, the U.S. government does step in with various kinds of tax help. Think of it as an incentive, right? A way to encourage families to save for what's become, almost essential. They offer tools like deductions, these specialized savings plans, and, crucially, tax-free earnings on the money you specifically set aside for education. Now, there are other options out there, things like Coverdell accounts, Series E bonds, financial aid, Pell Grants, scholarships, federal loans, state loans, lots of things. But 529 plans often stand out, mostly because of their higher contribution limits and maybe broader definitions of qualified expenses. That makes them pretty ideal for really substantial long-term savings goals.
That makes a lot of sense. So, okay, if these 529 plans are such a potentially powerful tool, what exactly are they, at their core?
Right. At its core, the 529 plan is what's known as a Qualified Tuition Program, or QTP. It's basically a special savings plan designed specifically to help you put money aside for future educational costs, sort of like a dedicated investment fund just for college or other qualifying education after high school. And these programs, they can be set up either by a state, think Pennsylvania, New York, California, loads of states have them, or sometimes by an eligible educational institution itself. So you're
Yeah.
essentially investing in a program that's managed either at the state level or sometimes by a specific school.
Ah, okay. That brings up an interesting point then. If I'm listening and trying to figure this out, what's the first big difference I need to understand? Because you mentioned there are different ways these plans work, two distinct types, right?
Absolutely. That's the key starting point. You've got two main flavors. The first major type is called the prepaid tuition plan.
Prepaid. Okay, so the name suggests, is this about buying future college tuition but at today's prices? Locking in a rate, like that example I mentioned earlier, tuition being 5 times higher. Imagine if you could have locked in those prices years ago. So this type of plan, it's designed specifically to hedge against that relentless rise in cost. Is that right?
That's exactly it. And from an investment perspective, these are generally seen as pretty low risk. And there's a good reason for that. See, the value of your investment isn't really tied to the ups and downs of the stock market. Instead, it increases at a rate that matches the average rise in college tuition. And given how education costs have historically outpaced things like regular savings accounts, CDs, and yeah, even the stock market in some years, this offers a remarkably predictable and often quite compelling return. And crucially, the growth in value within the prepaid plan, it's entirely exempt from federal income taxes. Plus, depending on the state where the plan is set up, it might also be free from state and local taxes too, which is a significant tax advantage.
Wow, that sounds incredibly secure. And you mentioned security. I heard many are backed by the state itself. That must add some peace of mind for a long-term investment like this.
It certainly can, yes. Many state-run prepaid plans do have some form of state backing, which adds that extra layer of security. But there is a critical consideration here, a potential catch, if you will.
Okay, what's the catch?
Well, imagine you've diligently prepaid tuition in, say, Pennsylvania, but then your child decides they want to go to university way out in California or maybe New York. That prepaid plan, it might not fully cover the tuition at an out-of-state college. Its value is based on the tuition rates in the state where you bought it. And out-of-state tuition can be significantly higher. So you could face a potential shortfall that you'd still need to cover somehow. The funds can still be used, absolutely, but they might not stretch quite as far as you'd hoped.
Ah, okay. That's a really crucial detail, especially for families thinking about, geographic flexibility. Good to know. All right, let's switch gears then. Let's talk about the second type, the educational savings plan. How does this one differ from the prepaid model, especially thinking about risk and maybe flexibility?
Right. So unlike the prepaid plan where you're locking in tuition rates, the educational savings plan is much more like a traditional investment account. The money you contribute gets invested, often in things like mutual funds, which are tied to the stock market. And this means its value can go up, it can also go down. You're not buying future tuition credits directly. You're investing money that you hope will grow enough to cover those future education costs and potentially, grow even more than you need.
So definitely riskier, but I guess with the potential for higher returns if the market does well. What's interesting here, I think, is that the control over the funds stays with the account holder, right? The person who put the money in, not necessarily the student, the beneficiary. What does that mean in practice?
That control is actually a really key feature, and it offers significant flexibility. It means the account owner, maybe the parent, or often a grandparent, decides how and when the funds are used. So let's say the beneficiary, the student, decides maybe not to go to college or gets a full scholarship and doesn't need all the money. The account holder can withdraw the money for other purposes. Now, taking it out for non-education reasons might trigger taxes and penalties on the earnings, which we'll get into, but the original principle is always theirs. Or, and this is quite common, they can simply change the beneficiary to another eligible family member, like another child, a grandchild, a niece, nephew, even themselves sometimes, if they're pursuing education. This maintains the tax benefits as long as it's used for education. So that level of flexibility, that control, is a major draw for many families. It also makes it a pretty sophisticated tool for things like wealth transfer, especially for grandparents wanting to help out.
Okay, so pulling it all together then, what does this actually mean for our taxes? Because that's, often the bottom line for families weighing these options.
Right, the tax benefits. These are really the headline feature for both types of 529 plans, and they're incredibly powerful. First off, any earnings, any growth in these accounts, that happens completely tax-free from a federal income tax perspective. Year after year, no taxes on the gains as they accumulate. Second, and this is really the kicker, distributions from the money you take out are also free from federal income tax, as long as they're used for qualified educational expenses. This combination makes them a remarkably efficient way to save over the long term. Now, there's a very important point here, a caveat you absolutely need to understand. The contributions themselves, the money you put in, generally you get no federal tax deduction for that upfront. This means you're contributing money that you've already paid income tax on. We often call it after-tax money. So the federal tax benefit isn't on the way in, it comes later. It's the tax-free growth and the tax-free withdrawals for education that deliver the value. It's delayed gratification, you could say, but it's incredibly powerful over time.
And just a quick note again on state taxes. While there's no federal deduction going in, state income tax rules can vary wildly. Some states might give you a full deduction for contributing, some partial, some none at all. It really depends on where you live and which state's plan you choose.
Got it. So federal benefit is on the growth and qualified withdrawals, not the contribution. Okay, so to make sure those withdrawals are tax-free, what exactly counts as qualified higher education expenses? What can you actually use the money for?
Yeah, the IRS has a pretty clear definition here. It includes the obvious things like tuition and mandatory fees, but it also covers books, supplies, and any equipment that's required for enrollment or attendance at an eligible post-secondary institution. Think computers, software, things like that, if required. And importantly, for students who are enrolled at least half-time, it also covers reasonable costs for room and board. So housing and meals while they're attending college can often be paid for tax-free from the 529.
Okay, good to know it covers more than just tuition. Now let's talk about getting the money into the plan. Contribution strategies, because I know there are some unique rules here, especially around gifting, that can really boost your savings. Generally, contributions kind of follow the annual gift tax rules, right? Like for 2023, you could give anyone up to $17,000 per year without any gift tax issues. So you can put up to $17,000 into a 529 for someone each year. No problem.
That's the standard baseline, yes. But here's where 529 plans have this really unique and strategically powerful feature. It's often called super funding. There's a special rule that lets an individual contribute up to 5 times the annual gift exclusion amount all in one single year. So using that $17,000 exclusion figure, you could potentially put $85,000 into a 529 plan for one beneficiary, all at once. This isn't just about avoiding gift tax. It's a really potent strategy to front-load the investment. You get a much larger sum working for you, compounding tax-free for a much longer time. It can really turbocharge the savings growth right from the start.
Wow, $85,000 in one shot. And if you're married, I assume you can double that, combine your exclusions.
Exactly. A married couple filing jointly can combine their individual exclusions.
Yeah.
So using that $17,000 annual limit, they could potentially contribute an astounding $170,000, 85,000 times 2, to a child's 529 plan in a single year.
$130,000. That's a significant chunk of change to put to work immediately.
It absolutely is. And the way the IRS looks at this large contribution is pretty neat. They treat it as if you made the gift evenly over 5 years. So if you put in $85,000 in, say, 2023, the IRS basically considers it as $17,000 contributions for 2023, 2024, 2025, 2026, and 2027. The main implication is that you generally can't make any more gift tax excluded contributions to that same beneficiary during those 5 years without potentially dipping into your lifetime gift tax exemption or paying gift tax. But the huge benefit, as you said, is getting that substantial amount invested up front, maximizing the time it has to grow tax-free for education. It'd be a really powerful way to set up future generations.
Okay, that superfunding rule is definitely something to keep in mind. All right, so fast forward. You've put the money in, maybe superfunded it, it's grown tax-free, hopefully, and now it's time to take it out for college. How do distributions actually work? And crucially, when does that money become taxable? Because I remember you said there are two parts. The original money you put in, the principal, and then the earnings.
That's right, two distinct components. Let's start with the easy one, the principal portion, the money you originally contributed. That part is actually non-taxable when you take it out, always. Why? Well, remember, you put that money in after you'd already paid income taxes on it. There was no upfront deduction. So when you get that principal back, the IRS just sees it as a return of your own investment, your own capital coming back to you. You don't owe taxes on it again.
Okay, principal is tax-free, got it. But the earnings portion,
Yeah.
that's where the nuance is, right? I'm guessing the taxation of those earnings depends completely on how the money is actually used. If the total you take out is more than your qualified education expenses, then the earnings part might become taxable.
Precisely. That's exactly how it works. And here's that crucial detail we touched on earlier, the one that often trips people up. Your qualified education expenses for this calculation must first be reduced by any tax-free educational assistance the student receives. Think scholarships, fellowships, Pell Grants, veterans educational assistance, employer-provided assistance, anything like that. So if tuition is, say, $10,000, but the student gets a $2,000 scholarship, their adjusted qualified education expenses for the 529 calculation are actually only $8,000. It's this adjusted amount that you compare against your distribution to see if the earnings portion stays tax-free.
Okay, that adjustment for scholarships is key. Let's maybe walk through a couple of quick examples just to see how the math works in practice. First, let's take Sarah's situation. Maybe one where nothing ends up being taxable. Okay, scenario. Sarah's parents put $15,000 into her 529. By the time she started college, it grew to $25,000. So that's $10,000 in earnings. In her first year, her qualified expenses were $12,000. But she also got a $4,000 tax-free scholarship. Good for her. She then took an $8,000 distribution from the 529. Let's say that $8,000 was made up of $6,000 principal and $2,000 earnings. What's the tax situation?
Okay, let's break down Sarah's case. First step, calculate her adjusted qualified education expenses. We call them AQE. That's her $12,000 in actual expenses minus that $4,000 scholarship. So her AQE is $8,000. Now compare that to her distribution. She took out exactly $8,000 in the plan, which included $2,000 of earnings. Since her AQE, $8,000 is equal to or greater than the total distribution amount, $8,000. All of the earnings portion, $2,000, is considered tax exempt. So in Sarah's case, none of the distribution is taxable. Every dollar taken out was effectively used for qualified expenses not covered by other aid. Clean and simple.
Perfect, that makes sense. Now let's look at another one, maybe Alex's example, to show how part of the earnings can become taxable. All right, Alex's situation. His aunt set up a 529, put in $18,000. It grew to $28,000 by college time, so $10,000 earnings there too. His qualified expenses were $10,000. He also got a scholarship, but this one was $7,000. Alex then took a distribution of $12,000 from the plan. Let's say that distribution was $9,000 principal and $3,000 earnings. What happens now?
Okay, Alex's turn. First, calculate his AQE. $10,000 in expenses minus the $7,000 scholarship leaves $3,000 in adjusted expenses. Now, he took out $12,000, which contained $3,000 in earnings. Here's where the calculation gets slightly more involved. We need to figure out what portion of the earnings is tax exempt. We do this based on the ratio of AQE to the total distribution. The formula is basically adjusted qualified education expenses, total distribution, earnings portion of distribution. So for Alex, it's $3,000 AQE, $12,000 distribution, $3,000 earnings. $3,000 divided by $12,000 is 0.25, or 1/4. So 1/4 of his $3,000 earnings is tax exempt. That's $750. The rest of the earnings become taxable. So the $3,000 total earnings minus the $750 tax exempt portion leaves $2,250. So in Alex's case, $2,250 of the earnings from his distribution is subject to federal income tax. The $9,000 principal, remember, is still non-taxable. And for listeners who want to see these calculations laid out, you can find detailed examples and worksheets on farhatlectures.com that walk through this step by step.
That calculation makes the difference really clear. Thanks. So if earnings do become taxable, like that $2,250 for Alex, is there usually a penalty on top of the regular income tax? I think I've heard about a 10% penalty.
That's generally correct, yes. There's typically a 10% additional tax or penalty applied to the taxable portion of the earnings from a 529 plan distribution if it wasn't used for qualified expenses. However, the good news is that this 10% penalty can be waived under certain specific circumstances.
Okay, what kind of circumstances waive the penalty?
Well, the penalty is waived if the distribution is paid out because the beneficiary has died, or if the beneficiary becomes disabled and is unable to continue their education. It's also waived if the beneficiary receives tax-free educational assistance like those scholarships we talked about, to the extent that the assistance creates the excess distribution. So if scholarships mean you have zero actual expenses left, the penalty on taking out earnings might be waived. And one more specific case. If the distribution relates to the beneficiary attending a U.S. military academy, like West Point or the Air Force Academy, the 10% penalty is also waived. The earnings might still be taxable, but no penalty.
Got it. So some specific hardship or scholarship-related exceptions. Okay, just to really hammer home this core concept then, one last time. When we talk about taking money out of a 529, what's the absolute key thing to remember about the principal portion, tax-wise? Why is it treated differently?
The absolute key takeaway for the principal portion is that it is always non-taxable when distributed. Always. And the reason goes right back to the beginning. You contributed that money with after-tax dollars. You didn't get a tax grade on the way in for that specific money. So the government doesn't tax it again when it comes back out. It's simply a return of your own capital, your original investment. The tax benefits are all focused on the earnings.
Right. No deduction in, so no tax out on the principal. Makes sense. And that really, for you listening, highlights the incredible power of these 529 plans. They are a genuinely valuable tool for tackling those rising education costs. They offer these surprisingly robust tax benefits, especially on the growth, and some really strategic ways to contribute that can make a significant difference in how effectively you save.
Absolutely. And when you think about just how persistently education costs seem to rise, and you weigh that against the significant tax advantages these plans offer, well, it really makes you ponder, doesn't it? How might getting started early, planning strategically with tools like these 529s, how might that shape not just a student's ability to afford college, but maybe their entire financial future, their trajectory? It goes beyond just paying tuition bills. It's potentially about building a much stronger foundation for financial well-being down the road.
It's definitely a question worth exploring. For anyone thinking about their own future, or maybe the future of a child, grandchild, niece, or nephew, we really hope this deep dive has given you a much clearer picture of these powerful savings vehicles and how they can be used strategically. Keep learning, keep exploring the options, and stay well informed.